Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So last night I put up a post on my community page saying that I was filming this Q&A video this morning, and we've got lots of questions. So thank you to everyone that asked a question. If you didn't get a chance to ask one and want to ask one in future, the best way is to turn your post notifications on so that you see every time I put up a new community post. Outside of Q&As, I actually do post on there fairly frequently, so if you're interested in following along there, definitely do that. But for now, let's get into the questions. There were quite a lot of them this time, so it's currently about 7:25 in the morning. I'll film till about probably 10 to 8 or something like that, so we'll see how many questions I can get through. Let's jump straight into it. So first question from Ailgi Aimer. Apologies if I'm butchering any names here, almost guaranteed that I will. What's the best option for passive investors on the ASX? I think I've never made a passive investment in the ASX, so I am certainly no expert on this, but I think my approach to passive investing in general is basically the same in any market. So in general, what you're looking to do when you invest passively is you're not necessarily looking to pick individual companies, you're looking to just track the average performance of the stock market and get a market rate of return. So if you look at the main indices over on the ASX, you've got things like the All Ordinaries or the ASX 200, ASX 300. So I know there's ETFs for all three of those. So depending on what you think is best fit for you, those would be the few things to look through. Basically, main stuff that I set up personally when I invest passively is I set up my dividends to be reinvested to get them sort of snowballing away over time and get more and more dividends paid each year. And I also look for things that have low fees. Those are the two things that will maximize your returns from those long-term sort of ETF investments. For Neiths, is Dropbox undervalued? Yeah, I actually had a bit of a look at some of the financials of Dropbox last night when you posted this. I don't know, it's basically the short answer. So anytime you go to value a business, you're projecting out the future cash flows of the business. So Dropbox is one of those companies that's only really just starting to be profitable. So they've got really unpredictable, in my mind at least, maybe you understand the business a lot better than me, but in my mind they have still quite unpredictable cash flows moving forward. They've only just started being profitable. We really don't know where they can potentially get to in 5 or 10 years time. So that for me makes it basically impossible to value with any degree of confidence. So that's my thoughts on Dropbox. What are your thoughts on investing in coal miners in Australia? So I've never invested in a coal mine in Australia. The only thing I would say is that really I treat almost every business pretty similar. Basically, project the future cash flows that you think you can do for that business and then try and pay an appropriate price for it. For some businesses, that's really easy. So Apple, for example, prints money like clockwork and it makes it really, really easy to value. Something like a coal miner is entirely on the other end of the spectrum. So they can have very, very unpredictable cash flows. They can be very profitable one year, lose a lot of money the next year. So it makes them harder to value. And if I can't value a business, I'm generally not going to invest in it. So that's my thoughts on coal miners. I've never owned one, but those will be some of the things that I kind of think through. Jason Yus 57, what do you think of A2 Milk given its recent price dip worth buying? So I'll never give stock tips on this channel. I'll never tell you to buy or sell or do anything with a particular stock. I will do stock analysis kind of videos on the channel, but I'll never give you a buy or sell recommendation or anything like that. So I'm not going to answer the second part of that question, but A2 Milk is a very good business. I made a video on it probably a year or two ago, going through kind of my understanding of the business. I work in the agricultural industry, so I at the time was quite skeptical about the actual benefits of A2. Since then, there does seem to be more science coming out to support that case. But one of the things I said aside from that in that video is that even if it's not backed by a lot of science, I think that these things can hang around for a long time. The end consumer is not an agricultural scientist. So you see these things with things like organic products. In my personal opinion, unless the actual farming system is quite different with conventional versus sort of organic farm systems and farm products, I don't really think there's any benefits at all to organic food. So if you're getting food from an organic sheep and beef farm, for example, in New Zealand, they are run fairly similarly to a conventional sheep and beef farm. They won't use certain drenches, and they won't use certain other pesticides and that sort of thing. But largely the stock are consuming pasture, they're consuming grass, and the end product is almost identical. So I think even though there's not necessarily a lot of science behind those things, the end consumer is basically always right at the end of the day. So A2 Milk's got a great business. They print a lot of money, they produce a lot of cash flow, they're growing, and they've been doing it for a long period of time. So for me, it's a good business, but everyone knows it's a good business, and the price is really high in my personal opinion. So that's kind of where I'm at with A2 Milk. I've never owned shares in the company. I've also never shorted it or anything like that, if you were wondering. But that's where I'm at with A2 Milk. If it got cheap enough, I would probably buy it. But I have pretty strict standards in terms of how cheap it would have to get. So it would have to drop something pretty crazy for me to get into A2 Milk. Generation Invest, how do you feel the market will react when NZ, Oz, and US release GDP numbers in the coming months? Don't know. I think individual company numbers are more important in terms of how the stock market will react. So, we have this massive discrepancy at the moment with, the underlying economy in the US being really, really shaky, and we're certainly in a recession pretty much all around the world. And then you have the stock market close to all-time highs. It's been pulling back a little bit the last week or so, but you have this big discrepancy, and I think a lot of the explanation for that is that the big components of the stock market, the really large companies in something like an S&P 500, like an Apple or a Amazon or all those sorts of companies that make up like 5 or 6% plus of the index just on their own, those businesses are not as affected. So that's the reason why, although underlying smaller companies and family-run businesses and stuff might be really struggling, the stock market just kind of keeps trucking along for whatever reason. So that is, I think, more important in terms of how the market reacts. GDP is obviously a very important metric for the growth of a country, but I think individual business results will have a far larger impact on where markets go and that sort of thing. But no one can predict that stuff in the short term. So in my mind, it's generally not even worth spending time on trying to predict that stuff. Wade Staples, hey Tom, what Kiwisaver provider are you with, and how did you choose this? Could you talk about this? Yep, I'm with Simplicity, so check out, not sponsored or anything, but check out my video on Kiwisaver on the channel. I do talk through that. Long story short though, kind of going back to the passive investing question, they have high exposure to shares. I have a long investment time horizon, so I want to have a high exposure to the share market or stock market, and they have low fees. So that's kind of the two things that pulled me over there. Karan Gunani, have you started taking up a position in Seritage? Yes, I have a very, very small position in Seritage. I don't want to overstate this too much, but I have like $1,000 position in Seritage. So relative to my overall portfolio, it's meaningless. Like if it tripled or quadrupled or something, even then it wouldn't have a massive weighting on my portfolio. So I have basically got Seritage in the portfolio just to continue to track it. Unfortunately, and I know a lot of investors don't talk like this, but unfortunately for me, since I've purchased it, it's up like 30%. So as I continue to understand the business more and more, unfortunately, the price just keeps going up, which is a bit of a bugger. But yeah, if it goes back down and if I feel like I understand the business enough and the valuation enough to make it a larger position, I will do so. But that's sort of where I'm at with Seritage. It's definitely not a no-brainer, which I generally like to look for, although there's a lot of good arguments out there that it is extremely cheap. Sam Wad, hey Tom, what sources do you use to get news/updates on the stock/the market that you have a vested interest in, e.g. Seeking Alpha once a week or Google email alerts? Cheers, keep up the great content. Thank you, Sam. So I am big on like just Google alerts, so I have probably like 15 companies that I get an email every week for with updates on what's happening with their business. So that's probably the main way I keep up. if anything significant is happening in the markets, generally I'll see it pop up on like a Facebook group, or maybe CNBC will put out a YouTube video that'll get recommended or something like that. So it's pretty hard to miss the big stuff really, but for me, I'm quite focused on individual companies. So I have a lot of Google alerts basically set up for many of the companies on my watch list, and maybe companies I'm digging into currently as well. So that's generally how I keep up. Tom Verdon, what is the process in order to recalculate intrinsic value of a company on a quarterly basis when the earnings reports get published? Sure. So I probably don't recalculate intrinsic value every single quarter or anything like that. Intrinsic value is always going to be a rough kind of range, and that's the reason we always look for a big margin of safety and massive discounts to intrinsic value. So I don't recalculate it each quarter unless there's been some significant news come out that is going to impact the growth negatively or positively of the company over the next several years moving forward. But I'll sit down probably once a year unless anything significant has changed in a shorter time frame than that. I'll sit down probably once a year and update my valuations and make sure that my estimates of cash flows, free cash flows moving forward is still, in my mind, a reasonable estimate of what the business is going to produce in the future. But intrinsic value is not something you can calculate down to 3 decimal points, every single day or anything like that. So I don't update it all that frequently, and that's one of the reasons why I'm searching for a massive margin of safety most of the time. So that's that one. Dive the World, would you do a feature on Michael Burry? I almost followed him in on MIK, Michael's companies, after the March drop. He's already sold it at a 5x or so, now considering whether Designer Brands Inc. might do the same, although over a longer period he isn't a classic value investor, but do you watch his moves? Yes, I usually follow his 13F filings. He's definitely runs a very different strategy to what I do. So he has long positions, he has short positions, which we don't see in his 13Fs, and he has a lot of option positions as well. So interesting approach, and he's famous from being in the movie The Big Short, where he's investing in derivatives and stuff as well. So all sorts of different stuff in there, but generally I find at least to be more of like a balance sheet focused investor for a lot of these companies. So he'll invest in just terrible, absolutely dying businesses like GameStop, for example, but they may, if they liquidated the company, there could be some substantial cash distributions and that sort of thing. So I do follow him. I'm yet to clone an investment or really dig super deep on any of the individual companies that Michael Burry's in, but definitely something I would consider doing a case study on in future if there was an interesting business that was right in my circle of competence that popped up. Elliot Henderson, what are your thoughts on Berkshire buying into Snowflake IPO? Have you looked into it? All I know about this is from an article that I've read that one of you guys sent me, so thank you for that. It definitely doesn't seem like a Warren Buffett move to be investing in such a software-heavy business, so I'm guessing it's Ted or Todd, and looking at the scale, I'm guessing it's Ted or Todd as well. It's not massively material to Berkshire Hathaway. It's not going to be like 10% of the overall capital or anything crazy like that. So I'm guessing it's Ted and Todd. I may well be wrong, but I would be willing to bet a reasonable amount of money on that. I'm guessing it's Ted or Todd, and it's great to see that those guys are getting involved in these, interesting these newer age companies, and also getting involved or having the freedom to be able to, buy into IPOs and stuff like that. I know that Warren Buffett does that very, very rarely, because typically in IPO you're getting a lot of people, original founders and early investors, trying to actually sell their stake in the company at as high a price as possible. So for Berkshire to be able to identify an IPO where a price potentially makes sense in their minds, really interesting, but I don't know a huge amount of detail about the individual company or the deal itself. So that is that one. Felix Yao, would Philtown's event-based investment approach mean that a company is never on sale? Thinking is that an event, while short-term, may lead to low trailing 12-month numbers, earnings per share, free cash flow, etc., and very low analyst growth rates. Does this mean we should use figures pre-event? Grateful for your thoughts. Thanks for everything. Thank you, Felix. So basically, I've probably said a few times in this video already, but basically, anytime you value a business, you're trying to predict the future to a large extent. So basically, it's probably a bit dependent on the company, but if you had a business that earns, say, $1 billion 1 year and then goes through this massive event and only earns $500 million and then goes back to 800, then 900, then 1.1 billion and so on, and kind of recovers and grows out of that. Using the trough earnings of like $500 million is not going to be representative of what might happen out into the future. So if those earnings and the free cash flows do drop, I wouldn't necessarily always use just what the really good year right before the event looked like. I'd make a rough sort of intelligent guesstimate based on what happened during that event and whether I think it's going to have long-term consequences for the business, and then try and figure out what's a more normal kind of earnings number or free cash flow number to start out with for that valuation. So if you were just to use trailing 12-month numbers all the time, you'd get huge ranges in your intrinsic value calculation, so I don't think that's the way to go about it. Definitely normalize, and the same thing goes for when companies are absolutely on a tear as well. If earnings are going up and up and up at crazy rates, particularly if they're a more cyclical business that is prone to going through peaks and troughs, it might make more sense to actually scale back maybe last year's earnings slightly and get a more normalized number as well. So those are some things to think about. Immortal Synergy, do you put water on your toothbrush before or after your toothpaste, or both? Cheers. Haha. Thank you, Ryan. I'm sort of a both kind of guy, I think, but let me know what you guys are into. Nipuni Pereira, what is your process when you are looking at a stock? Do you use stock screeners? I don't use stock screeners too much, really. I've spoken a little bit about the acquirer's multiple and the magic formula as screeners that I use every now and then, but I don't often find that many investment ideas out of screeners. And my process for looking for a stock, basically I follow kind of Phil Town's 4Ms, and there's a lot of detail within each of those. So I would maybe go and check out one of my previous stock analysis videos, maybe the Netflix one or the A2 Milk one or something like that, and that should give you an indication of how I kind of walk through that valuation or that analysis kind of process. So that's that. Kunal Dutta, again, apologies if I'm butchering your name. How to find accounting fraud? I don't know. I'm no forensic accountant or anything like that. I do know that there are some sort of quantitative things that you can look at, so I might do some research after this video and put some of those metrics up on the screen, because I forget the names of them, but I've heard guys like Toby Carlisle talk about that, so I'll try to put that up on the screen. I'm certainly no expert on finding accounting fraud, unfortunately. If I was, I'd probably be out there looking for it and trying to short the hell out of companies that are doing accounting fraud. But anyhow, Shreyas Sajeev, would you ever consider investing in developed countries like India? Sure. So I basically have no qualms with investing in a business in any country, as long as I understand it and the price makes sense, and I can, understand where the business is likely to be into the future. I'll basically invest in a business anywhere, whether that's New Zealand, Australia, and the US. Those are the three countries that I've invested in to date. But Buffett just put some money to work in Japan. I'd be interested in buying a company in Japan if it made sense to me. Depends on where the business is. It depends on the business and how attractive that particular investment is. I know people like Monish Pabrai have investments in the US and India and Turkey and I think South Korea as well. So money is money. I think whether a business produces cash in yen or whether they produce cash in Australian dollars or New Zealand dollars, as long as I can get that at an attractive price and I understand what the performance of that business is likely to be, I don't think it makes too much difference to me, where they are domiciled. So that's sort of my thoughts there. Claudio C. How to make sure you're investing within your circle of competence and not in what you think that circle is, but it actually isn't. Okay, sure. So I actually heard Charlie Munger get asked this question at a Berkshire Hathaway meeting at one point, and he basically said to ask the question is to answer it. So if you're not sure that you understand the business as well as you understand buying a rental property down the street, you probably don't understand it well enough. So that would be my answer to that. Finance with JCL, Berkshire Class B shares what percentage of your portfolio? Thanks. So I actually hold 0 Berkshire.B shares. I would hold Berkshire.B shares, but it actually makes up quite a significant percentage of my partner's portfolio. So I've chosen not to kind of double up by owning it myself as well. Yeah, it's all I'll say is it's a significant percentage. I won't probably disclose the percentage on here, but so I don't own it personally. My partner does. If she didn't own it, I'd probably own it, and I would have probably bought quite a bit earlier in the year when it was trading at like 1x book value. So not financial advice. So Jack Duffley, gold miners have been getting a lot of hype before and after Berkshire's Barrick move. Central bank driven currency devaluation would seem to work in their favor. Too speculative, or is there something there? I think that gold can potentially be a reasonable store of value over a long period of time. It's not an investment. In my mind, at least, it's not an investment. And Barrick Gold is a gold mining company. It's not an investment in just physical bars of gold that are going to sit around and do nothing. It's investments in a business that is going to produce cash flow. So the end product from owning Barrick Gold is cash flow. It's not gold sitting in a vault. So I don't own gold. I would much rather own businesses. If you're concerned about inflation, I think that high quality businesses with pricing power, like something like Coca-Cola that can move their price up over time, is just as good a hedge to inflation, if not a better hedge, than owning something like gold. That's my personal opinion. Same thing again with owning a rental property down the street. Houses are fairly inflation proof, historically speaking, and you can push rents up over time to account for any inflation that might happen. You're not going to have cash sitting in a bank that gets shriveled away if you've got that in high quality assets that'll just at least keep up with inflation, like a housing investment, or a business with pricing power. So that is my thoughts. What's your most recent investment? That is from Arsalan Ali. Seritage Growth Properties, which I spoke about earlier, is my most recent investment, although not a significant one really. Luke Smullen, how do you know when you've done enough research into a particular company to invest in it? I feel like I've found a great investing opportunity. However, as information is basically limitless, I'm struggling to figure out at what point I know enough to make it a significant position in my portfolio. Any advice on this? Thanks. Yeah, so this kind of goes back to the circle of competence question. So to ask the question is to answer it in a lot of ways. That said, if you're investing in multi-billion-dollar companies or even trillion-dollar companies, which exist at this point, you're not going to understand everything about the business. So you're pretty much always making investments, at least to a certain degree, on incomplete information. And I think your protection there, like in pretty much any investment that I get into personally, is margin of safety. So the risk really with any investment is all about the price that you pay. That's the way I think about it. So, if you invest in a business and you pay a really high price for that, a really high maybe multiple of the current earnings, or, if you do some sort of intrinsic value assessment and you're betting on at the current price, they have to grow at maybe 20% a year or something out into the future for that price to make sense and for you to make a good return. Then you need to have a lot of confidence in what the business is going to produce and how it's going to grow out into the future. Whereas if you can buy it at, a price where they only have to grow at, say, 10% for you to make a good return, but you think they're more likely to grow at 20%, then you give yourself a lot of added protection. So I think definitely continue to read about the business, listen to the conference calls, read the reports. You certainly will continue to understand a business more and more even after you own it. But I think paying attention to price actually is going to be a nice way to hopefully protect yourself in that area. So thank you for the question, Luke. And final question here. So from Shannon Hudson, are you saving for a farm? No, I work in the agricultural industry, but I really don't have a huge amount of interest, I must say, in going farming or anything like that. And from purely an investment perspective, the returns aren't, in my mind, particularly attractive. Farmers have done really, really well over the past couple of decades because there's been massive capital gains, and farmers have typically had a reasonably large amount of debt, so they've been able to take, a relatively small percentage of equity and grow that massively because of capital gains and so on. And it's got to the point where the cash returns are actually not all that attractive. So, it'd be a little bit like buying quite high-end real estate where you're only getting maybe 4, 5, 6% sort of cash returns. The best farmers in New Zealand probably get something like 9 or 10% cash returns on their investment, which is really good. But you have to be an extremely skilled operator to kind of get to that point. So, from purely an investment perspective, it's not something that is really on my radar, but you never know. I do like the idea of owning land quite a bit, and it's a great lifestyle and all that kind of stuff, but that's my thoughts on buying a farm. So thank you for all the questions. That was the final question from Shannon there, so appreciate that. And we're coming up on almost half an hour of recording, so I'd better call it there. So appreciate all the questions. If you did enjoy the video, please hit like and hit subscribe. If you do enjoy these Q&As, turn on your notifications so that you can see the community post for the next one. But that's all from me, so I hope you have a great day, and I will see you in the next one. Cheers.